Okay, the next one is DCF model, discounted cash flow model. Okay, so this is not the dividends anymore, but the cash flow, actual cash flow to the business. It says also called free cash flow method. So it's based on the assumption that your farm, the value of your farm equals to present value of farm's free cash flow. So instead of dividend, it's a cash flow from your business. Okay, then free cash flow is equal to EBIT, earning before interest and tax. It's basically your profit before interest and tax, and 1 minus T means you deduct tax, okay? Plus depreciation and amortization, all right? Why you plus this? Because depreciation in accounting, it's an expense, so it's minus. That is going to be minus. How do you call it? It's going to be less profit if you have depreciation expense because it's expense, but actually it's not a cash expense. There's no cash movement, so you have to plus it. Okay. Then minus capital expenditure. Capital expenditure is, in other words, it's investment. So if you construct new building, or if you buy new machines, or maybe you buy new computer, because you have to pay for it, so it's minus. Then it's actually minus as well, minus, and this is minus 2. Okay, change in net operating capital. It's current assets minus current liability. I don't want to get into this detail. It's more a little bit details in accounting. Okay, so this is how you calculate free cash flow. Okay, so DCF model, first you have to estimate free cash flow for next year, 2 years later. Then you have to discount by WACC. Remember we studied WACC already. So this is a discount rate for the company. Okay. Then use constant growth rate for the terminal value. Okay, I will show you what this terminal value is about in the next slides. Okay, so let's do the exercise. Okay, so I need Excel. Okay, so this company, so you already have CFC means free cash flow. Okay, so year 0, 1, 0, 1, and 2 and 3. Year 0, there is no cash flow for sure. Okay, year first you get minus 20. Okay, then 30, then 40. Okay. First question: what is those years terminal value? Okay, so this is a name of this company is called Dozier, I think. Okay, then how do you find out? So what this means is you already know the free cash flow for the first year, second year, and third year. But how about fourth and fifth year? Because if this company is to exist, then you will have some cash flow. Okay, but you don't know how much after this. Okay, then you use a constant growth rate. Okay, so constant growth rate. Okay, so it says during the next years and after fits, cash flow is expected to grow at constant 7% rate. That means after 3 years, this cash flow grows at 7% every year at the constant level. Okay, so 7%. Okay, how about R, or required rate of return, is equal to WACC, which is, it says those at WACC is 13%. 13%. Okay, then free cash flow 4. Year 4. How do you know? Remember, it's going to be cash flow for year 3 times 1 plus G, right? G is constant rate. It should be plus. Okay. Then your terminal value is equal to, we apply the formula of the constant dividend growth rate. Remember, I will show you. We apply this formula to the cash flow as well. This is not only for the dividend. You can use for anything. You can use this formula for the cash flow. Okay. Okay, come back here. Then terminal value is equal to year today divided by not year today, sorry. So terminal value equal to cash flow next year divided by R is 13 minus G, right? Okay, so it should be the terminal value. Then present value of terminal value. Okay, so this terminal value is based on year 3. Okay, but you are in year 0. Okay, so how do you calculate the present value? You guys remember? Is equal to this divided by 1 plus required rate of return, right? Power to how many years? 3 years. Okay. Okay, so it should be the present value of the terminal value. Okay. Second, what is firm's value today? Okay, so we already know the terminal value. So how about present value of cash flow for the next 3 years, right? How much is it? It's not difficult. It's equal to NPV, right? You can use NPV. How much is the discount rate? 30%. Right? Then for the future, these are your cash flow. Okay, so it should be 33. So total present value is, this is the present value for the cash flow plus present value of terminal value should be 527. This plus this. Okay. Next, it says suppose Dozier has a 100 million of debt and 10 million shares outstanding. Okay, so they have debt. How much? 100. Okay, it's million, right? I think this one is also million as well. Million, it says in millions. Okay, 100 million. And shares outstanding is how many shares do they have? They have 10 million shares. Okay, the question is, what is your estimate of current price per share? Okay, so company value should be present value, total present value minus debt, because this debt you have to pay to the bank, so to the creditor, whoever you borrow the money from, you have to pay back. So it's going to be minus from your present value of the company. Okay, so price per share should be this company value divided by how many shares do you have. Okay, so it's going to be price per share. It should be 42. Okay, so this is how you can estimate the share price from the cash flow. Okay, then your assignment, you have to do something similar, but this pretty much almost the same question, but I want you to try yourself. Okay, good luck.